What are management fees? Management fees are the primary way investment managers such as private equity, private credit, real estate, and venture capital fund managers cover their operating costs. These fees compensate the manager for sourcing deals, overseeing investments, and running the fund's day-to-day operations. While often discussed as a simple percentage, the reality is more nuanced. Common fee structures. Percentage of committed capital, the most traditional structure. The manager charges a fixed percentage, e.g., 2%, of the total capital investors have committed, regardless of how much is actually invested at any given time. This approach is most common during a fund's investment period. Percentage of invested capital. After the investment period, many funds shift to charging fees on the capital that's actually been deployed, invested, not just committed. This aligns fees more closely with active management. Step downs and tiered rates. Some funds include step downs where the fee rate decreases after a certain period or as the fund grows. For example, a fund might charge 2% during years 1 to 5, then 1.5% thereafter. Hybrid and custom structures. Certain funds, especially in niche or emerging strategies, may negotiate hybrid models or performance-based fees. These can include minimums, caps, or even flat dollar arrangements. Typical rates: private equity, historically 2% of committed capital with some downward pressure in recent years, especially for larger funds. Private credit, often 1 to 1.5%, sometimes lower for large or direct lending vehicles. Real estate ranges widely, but 1 to 1.5% is common. Venture capital, still often 2%, but with more frequent step downs or offsets. Rates can vary based on fund size, strategy, and investor negotiation. Larger funds often offer lower rates due to economies of scale, trends, and market dynamics. Fee compression: investors are increasingly focused on net returns, leading to downward pressure on management fees, especially for large or repeat funds. Alignment with performance. There's a gradual shift toward fee structures that better align manager incentives with investor outcomes, such as more fees based on invested, not committed capital. Customization. Institutional investors are negotiating more bespoke fee arrangements, including tiered rates, offsets, and co-investment fee waivers. Illustrative example: a $500 million private equity fund might charge 2% on committed capital during its 5-year investment period, $10 million per year. Afterward, fees might drop to 1.5% on invested capital, which could be $400 million, resulting in $6 million per year. Bottom line, management fees are evolving. Understanding the structures, rates, and trends is essential for fund managers and investors alike. As AI and data analytics become more embedded in fund operations, expect even greater transparency and customization in how fees are set and managed.